Ladies and gentlemen, welcome to TotalEnergies first quarter 2026 results conference call. I now hand over to Patrick Pouyanné, Chairman and CEO, and Jean-Pierre Sbraire, CFO, who will lead you through this call. Sir, please go ahead.
So good afternoon or good morning, everyone. Happy to be with you again today. So before Jean-Pierre will go through the details of this first quarter financials, I would like first to make some few opening remarks, in particular on the conflict and in the Middle East and its consequences. As you know, this region, Middle East, holds, of course, a very special place for TotalEnergies. It's deeply rooted in our DNA, in our history, in our identity, because it is where the company was born in 1924. In Iraq, and more importantly, this is a region where we have established along the years a prime position which differentiates ourselves. Since the very first day of the conflict on February 28, our priority has been first the security of our teams and their families, and we have decided just 2 days after to organize the evacuation of employee families, and as well as some non-essential employees out of the UAE, Qatar, Iraq, Saudi Arabia, Jordan, and Lebanon. Thanks to the strong mobilization in all our affiliates in the regions, but also around the globe, and also at the headquarters, more than 1,300 people have returned safely from the countries concerned by the conflict, and I want to thank all the teams who participated to that strong effort. Safety of our staff will remain our utmost priority, but I want also to reiterate here our full solidarity and support for the population of these countries which suffers the consequence of the conflicts, and I want to reaffirm TotalEnergies' commitment to all our local partners, contractors, and customers. From this point of view, I want to underline that we kept a presence in all the countries aside our partners. For example, in Abu Dhabi, all our secondaries working for the ADNOC JVs are maintained on the ground. It's the same situation in Qatar. We have also, by the way, sent some experts to assist TotalEnergies in evaluating the damage and repair necessary to the 2 trains which were damaged during the conflict. We have maintained a team in Iraq, in Basra, of 20 TotalEnergies staff, who are supervising the progress of the GGIP projects on the ground with around 5,000 workers there. And also in Saudi Arabia, we have, of course, maintained most of our secondaries in order to supervise the Amiral projects, which mobilize today 22,000 workers. So my message on this first is to thank all our teams, which are, again, working hard in the region, facing the situation. I went myself last week to visit them, and I can tell you I had a strong feeling of a high mobilization of everybody facing these adverse events, and also I met, of course, our partners and authorities to reaffirm our commitment to the region. Of course, we will have to draw some lessons from what happened, in particular to envisage some alternative evacuation routes for the production of oil in the region, but that will come after the conflict. This conflict immediately has some impact on TotalEnergies' operations, and we have been, by the way, very transparent, I would say, since day one, to disclose all the impacts on our activities. So at this stage, production is shut down in Qatar, Iraq, and UAE offshore, which represents approximately 15% of the total oil and gas production of the company. More precisely, 360,000 barrels per day, because we continue to produce onshore UAE oil productions, 210,000 barrels per day TotalEnergies shares, which is evacuated through Fujairah terminal out of the Strait of Hormuz. And we also continue to produce the Dolphin gas between Qatar and UAE because it's, I would say, a domestic Gulf production. While this is a significant portion of our production upstream, these Middle Eastern assets contribute less to our cash flow per barrel than the rest of our portfolio due to higher taxation in the regions. And these 15% of volumes, a little less, 360,000 barrels per day, are for only account for roughly 10% of our upstream cash flow at $60 per barrel. The company's cash accretive growth expected for 2026 is largely outside the Middle East, and you've seen that through the results of the first quarter, meaning that the higher oil price observed since the start of the crisis more than offsets, of course, the loss of production in the Middle East. An equivalent of $8 per barrel increase in the Brent is enough to offset the expected 2026 CSFO from the shut-in production. And we are, of course, today of more of $100 per barrel, I think even $115 per barrel this morning, which in terms of our sensitivities to price, represents substantial additional cash flows. The impact on the LNG production shutdowns in Qatar or in Abu Dhabi on our energy trading activities are in fact very limited, as our exposure to our marketing portfolio is limited to 1.5 million tons for the remainder of 2026. I remind you that most of the energy produced by our JVs in Qatar are in fact marketed by QatarEnergy itself and not by TotalEnergies. Finally, on our refining activities in the region, the SATORP site, which is owned jointly by Aramco and TotalEnergies, was impacted by strikes that occurred during the night of April 7 to April 8, causing damage to 3 units. No casualties were reported. As a safety precaution, the units were immediately shut down. A partial restart occurred on April 14, allowing to resume production at a 50% capacity, 230,000 barrels per day. And the repair work on the first one of the unit, a VDU unit, are well underway, and we expect to restart and to increase the production to more than 300,000 barrels per day from beginning of early days of May 5th or around. So that's the situation for assets. But this conflict, of course, has consequences beyond or the only perimeter of TotalEnergies, and now will impact the course of 2026 very significantly in terms of markets. Although the damage to upstream assets has been limited so far, the closure of the Strait of Hormuz constitutes a major disruption to the world energy system, as it affects around 20% of worldwide oil, crude oil, refined products, and of course LNG exports. And there is very limited spare capacity of production outside the Gulf in reality. So the immediate consequence was a surge in oil prices, which are now around $115 per barrel, which have been extremely volatile with major swings in the past weeks. Some days have been the highest days. I think we experienced 8 of the 10 highest volatile days in the last 25 years during the months of March and April. So given the time required to restart facilities, but also and more importantly to reach the markets, because the oil tanker which will be loaded in Abu Dhabi or in Saudi Arabia will take 25 days of shipping to reach its customers in Asia, Korea, Japan, and so there is a time lag. Even if the war was to end quickly, prices are expected to remain at high levels. And in all the scenarios I can read, and I agree with the scenarios I'm reading, either from the IMF or from some banks, at least $80 per barrel is expected for 2026. In fact, the reality is that the 2026 surplus scenario that was anticipated by the markets and by ourselves, by the way, at the beginning of the year is now over, is behind us, with global hydrocarbon inventories being materially drawn to balance the market, already at a pace of 10 to 13 million barrels of oil per day. We have already consumed, I would say, 500 million barrels out of inventories, and with the phenomenon I described to restart and to reach the market, it's probably more 1 billion barrels, which will at least be consumed from the inventories, and we would exit, even if the conflicts, and I hope so, will end in the month of May, we would exit the conflict with clearly some very low inventories. So this conflict also has some impacts on the LNG markets and prices. We have seen that the European gas price have established today at around $15 per million BTU. But again, we are facing now, by this summertime, the peak season for LNG because it's only the warm summer season in Asia, which will grow and which will call for more LNG demand. But also it will be a season where Europe will have to replenish its storage. As you know, at the end of the winter season, we were at the lowest point of the last 5 years in terms of European gas storage, around 25%. And we anticipate as well, and I was in Qatar, that QatarEnergy will wait for a real stabilization of the Strait of Hormuz before to restart the liquefaction plants. You cannot turn off these plants easily. So it will also impact, I would say, the time it will take to reach the market. So that's on LNG, and I would not be surprised to see some support from higher prices by summer season, considering this time lag that LNG could go back to the market, and QatarEnergy represent almost 20% of the world market. So in this context, the strategy of TotalEnergies demonstrates once again the ability of the company to capture price upsides, thanks to major strategic strengths of the company. And also, I must say, and I compliment the team because of a strong operational performance, which of course is of essence in such markets during the first quarter. First, of course, we are integrated along the value chains of oil, gas, LNG, electricity, and allows us to capture margins and prices all along the value chains and provide us with a unique combination of activities in oil, gas, electricity, being a low-cost producer, transforming them into added value products which can then be traded on the market and sold to our B2B, B2C customers. Secondly, we are a growing company and a strong organic growth. And even we are demonstrating quarter after quarter our ability to strongly grow our production. Have you seen a 4% year-on-year organic production growth for the oil and gas business, and also, of course, electricity business. 4% for oil and gas was above our annual guidance of 3%, and which, of course, helps to offset, if not completely during the first quarter, it was completely during the first quarter, will be partially during the second quarter, the impact of the Middle East conflict. But more importantly, it allows us to capture the upside of the high prices, because the incremental productions, the new production that we put on stream is more accretive and generates more cash flows per barrel than the average of the portfolio. Third, we are diversified, and I think this is again a strong lesson of this crisis. Strong diversification or rich and diversified portfolio allow us to compensate again the impact of the crisis in the Middle East through our geographically diversified portfolio of oil and LNG outside of the region. It notably allow us to activate the flexibility of our LNG portfolio to ensure the security of supply of all our customers. And the diversity of the LNG portfolio, we are producing in 11 different countries, allow us to serve our customers in Asia, rerouting some non-contracted volumes that we have in our portfolio to them, and not to declare any force majeure in our contracts. I can assure you, because I visited some customers in Asia, but they appreciate very much the value of the contract commitment at TotalEnergies. We have also, I would say, and it's another example of the optionality and of our diversified portfolio, I would say that more than ever, the decision to restart the Mozambique LNG construction in January could be fully appreciated, because it's a diversification which will be good for our portfolio by 2029. It was an article recently in a journal that the Mozambique will be the Qatar of Africa, and we are proud to build these projects in Mozambique, and it will help us to diversify and I would say as well, as we are working hard, these events are giving a good momentum to sanction Papua LNG before year end. So in this context, of course, and compared to the beginning of the year where we were all cautious, there are no reason not to fulfill all our commitments for strong returns to shareholders. And I think the board has taken decisions yesterday that I'm happy to report to you. And considering, of course, the strength of the balance sheet, but also the environment, and taking into account the ability to demonstrate our growth, Priority was again given to what I call the sacrosanct dividend by continuing to it's our strong track record of dividend growth, and we have decided to increase the first interim dividend by 5.9%, above probably market's expectation, to 0.9 euro per share, compared to last year interim dividend, which was 0.85. So we confirm once again the leadership of TotalEnergies, not only in terms of dividend resiliency, but also more important, dividend growth among the oil and gas majors. Secondly, in view, and we are, I would say, very pragmatic and consistent, once again, in view of the current projections of the evolution of the prices, not only the second quarter, but as I said, along the year 2026, the board of directors gave us the authorization to continue, of course, the share buyback program up to the high end of the range that we gave last February, which was $750 million to $1.5 billion per quarter. So we'll target the high end of this range up to $1.5 billion per quarter. The board also reiterates the objective to achieve the cash payout ratio above 40% for the full year 2026, and we will monitor buybacks accordingly along the year. Keep as well in mind that in terms of capital allocation, board attach great importance to deleverage the balance sheets, and we would be happy to see a gearing in the low tens by the end of 26 if the barrel price or if the crude oil price was remaining above $100 per barrel. On that note, and I will now turn to call to Jean-Pierre, who will go through the details of the first quarter financials.
Thank you, Patrick. So I will start by commenting on the price environment in the first quarter versus the first quarter 25. So Brent averaged $81 per barrel during the first quarter versus nearly $64 per barrel in the first quarter, up more than 25%, and average liquid price was up by $12.4 per barrel due to the time lag effect, in particular in the Emirates. TTF averaged $13.7 per million BTU versus $10.3 per million BTU during the fourth quarter 25. And our average LNG price stayed at $8.5 per million BTU, oil price increase impacting LNG prices with 1 or 2 months of lag time according to LNG pricing formulas. Finally, the European refining margins remain at $11.4 per barrel on average over the quarter, with exceptional margin in March and poor margins in January and February. In this price environment, the company reported very strong financial results with first quarter 26 cash flow of $8.6 billion, increasing by 20% compared to the first quarter, and adjusted net income increasing by more than 40% to $5.4 billion. These results, as already highlighted by Patrick, were possible because of a strong operational performance of all businesses, which demonstrated the company's ability to fully capture the environment upsides. Upstream delivered a 4% upstream underlying accretive production growth, offsetting the production loss due to the crisis in the Middle East. Downstream, a very good operational performance of our refinery with an utilization rate on average over the quarter above 90%, that allow us to capture high refining margins in March. And trading was also able to take benefits from the high market volatility in March and deliver the high performance on crude, petroleum products, but also LNG. TotalEnergies has delivered a strong profitability this quarter with return on equity at 14.4% and a ROACE at 12.7%. Now moving to the business segment and starting with hydrocarbons. On a year-on-year basis, excluding the impact of the Middle East conflict, first quarter oil and gas production exceeded expectation and increased by more than 4% above the guidance provided of 3% for 26. As communicated by the company from the very beginning, the production was impacted by the conflict in the Middle East, with an impact of around 100,000 barrels per day on average for the quarter, which correspond on average to around 20 E&P, exploration and production. So turning to quarterly results and starting with E&P division, the segment generated an adjusted net operating income of $2.6 billion this quarter, up by more than 40% quarter to quarter, fully capturing the increase in average liquid price of $12.4 per barrel over the quarter and demonstrating the accretiveness of the new projects. This quarter, Lapa Southwest in Brazil, Mabruk in Libya started up and will each, once ramped up, bring an additional production capacity of 25,000 barrels per oil equivalent per day. Similarly, cash flow reached for E&P $4.6 billion, up 26% quarter to quarter. On the cost side, once again, we maintain our leadership with an average OPEX per barrel of oil equivalents below $5 in the first quarter 26. On integrated LNG, so on the production side, LNG production, it has grown significantly by 12% quarter to quarter, mainly supported by growth in Australia, with it is back to full capacity during the quarter, the United States and Malaysia. First quarter LNG sales reached 12.4 million tons, supported by strong spot activity, giving us a strong start compared to our yearly guidance of more than 44 million tons. Supported by this growth and strong trading activity capturing market volatility, the adjusted net operating income of integrated LNG was increased significantly quarter to quarter to $1.3 billion and cash flow to $1.8 billion. Given the evolution of the oil and gas prices in recent months and the lag effect on pricing formulas I already mentioned, the company anticipates an average LNG selling price of around $10 per million BTU for the second quarter of 26. As we execute our consistent strategy in LNG, the main milestone of the quarter was the full restart of construction activity at our Mozambique LNG project, with more than 6,000 people already on site as we speak. This project was broadened the diversification of our LNG supply, a strength that the current crisis has put an additional emphasis on. Turning to integrated power now. So net power production increased year on year to 11.7 terawatt-hour, with a 20% growth of power generation from renewables, offsetting the lower utilization of gas flexible capacities in the context of lower winter demand in Europe and in the United States. TotalEnergies has increased its renewable capacity by nearly 8 gigawatts over a 12-month period, on track to reach its objective of 42 gigawatts gross installed capacity at the end of the year. Cash flow from operation was $0.6 billion, as no farm downs were registered during the first quarter 26, unlike in the first quarter 25. This quarter again, we provide more granularity in integrated power financial performance, with a split in cash flow between production assets on one side, renewable and gas-fired plants, and sales activity on the other side, B2B, B2C, and trading. The former contributed 35% of the cash flow, and the latter for 65%, in line with the first quarter 25, due to the seasonal nature of the marketing business, with more consumption, obviously, during the winter. And given the closing of EPH deal that we announced this morning, TotalEnergies has now a 50% interest in a portfolio of flexible power generation assets in Europe, and integrated power should then benefit in 26 from 10 terawatt-hour of net power production, in line with the 15 terawatt-hour guidance given for the full year, and more than $500 million contribution to available cash flow in relation with this EPH deal. Moving to downstream, and during the first quarter, refining and chemicals was able to capture the exceptional margins in March, thanks again to the high availability of the refineries, which recovered their full operational performance. It was particularly the case in Port Arthur in the US and Donge in France. Utilization rate reached 92% in the absence of planned turnarounds, and trading activities was also very strong for crude and product, taking benefits of the market volatility. Overall, for RC, adjusted net operating income was up by nearly $600 million quarter-to-quarter to $1.6 billion, and cash flow reached $1.7 billion. In marketing and services, results remain consistently strong and reflect the seasonality of the business, with higher margin activities offsetting lower volumes linked to the disposal of some assets in Brazil and in Sahel, in Africa. Moving to corporate, to company level, and starting with working cap. So working cap increased by $5.1 billion during the first quarter, out of which $2.5 billion is related to guide business seasonality, and $2.6 billion that reflects the impact of higher hydrocarbons prices at the end of the quarter, notably on inventories. While the context remained quite volatile, we deploy our investment program with discipline, with net investments that amounted to $4.5 billion in the first quarter, with a neutral balance between acquisition and disposal, in line with our quarterly budgets, and we therefore reiterate full year 2026 net investment guidance of $15 billion. As a result, the gearing lands at 15.5% at the end of the quarter, with cash flow growth driven by higher energy prices, partially offsetting, in particular, the impact of high prices on the working cap build. Looking forward now, we expect to maintain strong momentum with hydrocarbon production, excluding Middle East impacts, in the second quarter expected to grow around 4% compared to the second quarter 2025, in line with first growth we registered during the first quarter. As we speak, as mentioned by Patrick, production shutdown in the Middle East still represents around 15% of the company's total production, and we anticipate refining utilization in the range 80-85% in the second quarter, which accounts for a 2-month scheduled maintenance at Donges and the impact of the capacity reduction of SATORP commented by Patrick. As I mentioned, the company confirmed it expects its yearly net investment to be at $15 million for the full year, in line with annual guidance. Therefore, net investment should trend downwards in the second quarter. Meanwhile, the company is evaluating options to accelerate short-cycle investment to capture current hydrocarbon price environments. To conclude, the set of growing earnings clearly demonstrate, in our view, the strength of our integrated model in oil, gas, and power, which enable us to seize price upsides in the first quarter and put us in a strong position for the second quarter and the rest of the year. With that, I think with Patrick, we are now available to answer your question, so you can open up the line for questions, please.
Thank you, ladies and gentlemen. We will now begin the question and answer session. As a reminder, if you wish to ask a question, please press star and one on your telephone and wait for your name to be announced. Please kindly mute any audio sources while asking a question. If you wish to cancel your request, please press the star and 2 key. Once again, please press star and 1 if you wish to ask a question. The first question is from Michele Della Vigna, Goldman Sachs.
Thank you very much, and congratulations on the strong results. I wanted to ask 2 questions on LNG. The first one is about whether, with all of this crisis, you're starting to see a resurgence of demand for oil-linked long-term contracts, and if that can unlock more LNG projects for you, like, for instance, PNG. But longer term, I was also wondering if this crisis may actually be a bit more concerning and reduce some of the dependence on hydrocarbons from Asia, for instance, turn some of those countries more towards coal, solar, and energy storage as an alternative, and if that could actually make perhaps what already looks like probably an oversupplied LNG market from 2028 last well into the next decade. Thank you.
Okay, I will take the second one first, Michele. It's quite clear, for customers in Asia, a crisis in 2022, another one in 2026. Reliability, I would say, from an affordability point of view of the LNG will be questioned. And that's why, by the way, we think we have to promote to them the idea of long-term contracts, not only related to spot price. That's very clear. That's what the Europeans because their role are not benefiting from. I think it should influence, put them more on this type of long-term contract. You are right. But that way the whole planet, not only in Asia. I think the governments will look again to, like we were in the 70s, domestic production first, I would say, domestic energy first, whatever it is, coming from coal when you have coal, coming from biofuels, by the way. Malaysia, Indonesia are beginning to raise their biodiesel content, very logically, but coming to renewables, of course, as well, and from this position, our company, TotalEnergies, could benefit from it because we are also investing in electricity, I would say. So that will be, and I would say electrification will be also a global answer because it will give, you can produce electricity from various means and not only from hydrocarbons. So that will be the other big trend, I think, we will see because security of supply, because again, affordability of energy is of essence. So it's not a very good news, I agree, for the LNG markets. As you said, probably the result of this crisis as well is that we push back some of the, I would say, the famous wave. I think because there will be some delays in some projects, because we are, by the way, don't know today how long the war will last. We have no idea. But I always said that 26 will remain a good price. I think 27 we can be optimistic. Then what you said, the oversupply LNG market will come from 2028. But I would say, by the way, that it's not bad for customers to have an oversupplied market. One of the observations I've done when I observe what happened today with the crisis, and it's quite remarkable. I know only two markets today where there will be no impact on the crisis on the energy price. One was the U.S. domestic gas price, the Henry Hub, still remain at even lower at $3 instead of $4 before, or 3.5. Why? Because there is an oversupply, there is overcapacity. The Permian gas, now it's connected through pipelines. And the other market I observe is French electricity market, no impact at all, because also overcapacities of nuclear and renewables, by the way, both. So we produce too much. And so that means that it is a way to secure the affordability. So from this perspective, because of what you said and the fear which could be generated to our energy customers, the fact that we'll enter at a certain point when probably more summer 28 than before, or winter 28, I would say, a lower cycle, would be good to convince them to come to us. I make a link with your first question. Honestly, today, I think we were happy and lucky to have signed a lot of oil-linked contracts because in this context, where there is sort of bullish price of oil. We have always quite be bullish, but I think this context, the crisis, will also impact, I would say, this oil market, because there will be now something which was completely even hypothetical, which in fact was only putting in the risk cartography, which was the closing of the Strait of Hormuz, became a real possibility. It's materialized, this threat. This threat is materialized. And you have in the Gulf, more than 20% of the 30% of the oil resource, oil and gas resource. So clearly, I think this will have an impact on the way that the markets will, I would say, take this threat into, even if we go to a stabilized situation for the Strait of Hormuz, will have an impact on the markers, on the Middle East markers, I would say. So today, I think we are happy to see that. We see appetite from Asian buyers for Papua LNG, not only because of the contract, but because of the geographical position, I would say. Of course, Papua LNG is perfectly located, not far from them, outside, so any diversity is good. But on our side as well, we think that we are, by the way, because of this geography, we will see if we sign long-term contracts for Papua LNG or if we keep some LNG for our own portfolio, because we like this LNG as well for our own portfolio. So we'll be, but again, no problem from this perspective to sign, and we might be, I would say, in this context, a little tougher in the negotiation. What I've observed the last week, some Asian buyers come back to Henry Hub Plus because they just observe what happens, and the stable, I would say, and affordable gas marker is the Henry Hub. I think so. There will be quite a lot of new popularity for the Henry Hub Plus if some LNG off-takers want to sell their LNG there. But definitely, this crisis has an impact on all this global energy market. Having said that, you've seen our results during the first quarter. Where you have a strong, diversified portfolio, you can do good results when you have volatility. And I think we demonstrated that with our teams during the first quarter. I think we'll continue for the next quarter as well.
Thank you, Patrick.
The next question is from Biraj Borkhataria, RBC.
Hi, thanks for taking my question, and thank you for the comprehensive overview of your operations. The first one is just on the comment in the release around accelerating short cycle investments. Could you just unpack that a little bit more? What opportunities are you looking at? And secondly, kind of what are you looking to see macro-wise or otherwise to put that capital to work? And then secondly, just a follow-up on Papua New Guinea. Could you just talk about the steps from here to FID? Are the fiscal terms all now agreed and tenders and so on? Just any uncertainties there ahead of FID? Thank you.
Okay. First question. I mean, you would have been surprised, but we didn't mention that. I'm sure I would have a question. So it's quite natural from the CEO of the company that I've asked to my E&P teams, okay, is there anything to accelerate on the short cycle to benefit from a higher price deck? Because again, on 26, I'm quite, be confident is difficult in this world, but to see at least $80 per barrel, I don't think I would put quite a lot of my own money on it for the rest of the year. So, by the way, it's an exercise which is moving on. I know there are few countries like Angola, for example, where they have some ideas. So if we need to dedicate a few $100 million to that, I would do it. It will be, maybe I will tell you at the end of the day, but it's not 15 billion, but 15 to 15.5 billion, but you will accept it if it's profitable on the short term. I think, honestly, I'm not sure it's so big, because in fact, when we built the budget, we did not arbitrate a lot of short-term cycles. In fact, we had a list of what we could cancel in case the price of oil was going down to $50 per barrel. So we prepared in case of, I would say, adverse market. But we have asked the questions, and I know that because I visited some countries, but I have some few ideas. So I can be flexible on keeping the discipline. But again, if we can generate some good free cash flow on the short term, everybody will appreciate it. So it's not probably as big as I just mentioned. It's probably a few $100 million that we could mobilize, so subject to capacity to have the rigs, etc. So we are working on it with some countries. On PNG LNG, I think it's a big project, many partners. We have in parallel some, I would say, at least 4 workflows. So the CapEx side, I would say, and the EPC are progressing very well. We have made some recommendations to our partners. We are waiting for the approval from one of them. So I hope we will get it soon, so that we can move forward with these tenders. In parallel to that, we have, I would say, the financing of the project, because there is a project financing. Both are linked, by the way, because as you know, selection of the nationality of some contractors have an impact on the involvement of export credit agencies. So we need to do, there is a little sequence there. So we need to have decided the contractors so that we can definitely confirm to the different credit export agencies. So that's also, I think there is some appetite clearly from Asian credit export agencies, but also we discussed with the US ones about it. And so we are moving on the financing of it as well. So it's the second workflow. The third workflow, as you said, is a discussion with the government. They are progressed, I would say. I could almost say finalized, but I didn't see the ink on the paper. But between the government and ourselves, there is an understanding on the agreement. So I consider, of course, it will have to be again approved by our partners. So we are I would say, now in the process to close the loop, I would say, between the partners, government, on these end terms. Fiscal terms, the idea there is somewhere to protect the projects. The capex will be around 14.5 billion, so it's quite. It's not too cheap. It's much better than the 18 billion, but it's still cheap. So the idea is to protect the projects when the price of oil are low and to give back some when the price are high, above $90, I would say. So there is a sort of trade-off, which is good which would be good. And the fourth one is marketing. On the marketing. So on the marketing, there is some progress, quite a lot of progress. But again, on our side, the more we look to Papua LNG, the more we have appetite for the LNG located in that region and diversifying our portfolio. So it's possible that we could market out of, because we market not only our LNG, but the one of Kumul as well. We could market maybe 1 million tons on the long term and keep the other 1.5 to 2 for our own portfolio. So we are looking to different options. So all that is progressing. I would say the target is to sanction the project for sure before the end of the validity of the offers, which is I think around November. So because in this market, we don't want to reopen and to negotiate to extend offers. We could face some inflation there. So that's I think, and we are aligned, I think, with the partners on moving to the FID second half of the year. With the governments, for sure. There is a last point to clarify, if I want to be exhaustive. We need to be sure of the way that the Kumul financing, there is a Kumul back-in, and we need to know exactly what is the back-in which will be exercised. So, but all these workflow, we are working on them in parallel to converge to the FID.
Thank you very much.
The next question is from Lydia Rainforth, Barclays. Please go ahead.
Thank you, and good afternoon to you both. Two questions, please. Could you just touch on the early closing of the EPH transaction and what options that now gives you? And then secondly, could I come back to the cash return side? I just want to be clear about what the message is around where we see cash returns going through here, because obviously you're at the top end of the guidance that you'd given, but that was at $60 to $70, and I'm just trying to work out whether you're prepared to, whether you would go beyond that, or whether the priority then is the debt side coming down. So I just want to be clear on the messaging around cash returns for the rest of the year. Thanks.
Okay. So first point, EPH. First, we have been, and teams have been very efficient. By the way, the antitrust supervisories also have been super efficient, because even in Europe we've been 3 calls to get the approval on these transactions, which allow us to close end of April instead of end of June. So that means that we are now entering into this new company, TTE, at a time which, by the way, is not too bad, because as the gas price are higher in Europe, and the electricity price in a country like Italy, we have a big exposure now to Italy. Italy is facing some increase of electricity price, and so this gas-fired power plant fleet will have a little higher margin. In fact, some €2 per megawatt hour beyond, I would say, the normal average margin. So it's positive. And the second good news, recently the EPH team managed to get very attractive new capacity contracts for some plants in Ireland, around 200 pounds per kilowatt hour. So we come with a time where it's good news. So first, I'm happy to join to make it earlier. And it gave us, of course, options, as you know. Now we will have access to 50% of the electrons of all this CCGT fleet. And so this will allow our teams to increase our trading business, but also to go to customers to sell them clean firm power with combining gas and electrons coming from the gas-fired power plants, flexible electrons with the renewable electrons. So that's exactly the pace. So we will move forward. We gave you some indications, I think, in the press release about the impact because it's from 1st of May. So I think we evaluate the impact on the production around 10 terawatt hour, and we told you that the cash flow should be at least 2/3 of an annual cash flow, which means at least $500 million of impact, maybe a little more. We see. Let's enter in the venture. So it give a push to the integrated power business, and you should see next quarter and third and fourth quarter, I would say, in the results and the cash stepwise compared to this level where we are today. Cash return. I mean, let's be clear. We are going step by step. We gave you yes, you're perfectly right on the buyback. We gave you at the beginning of the year $750 to $1.5 billion between $60 and $70. So we told you immediately on the second quarter, we'll monitor that quarter after quarter, to be clear. We go to the high end of the range to $1.5 billion for this quarter. And then I have added in my comments that we are guided by another objective, which is 40% of payout. So if you make the math, you will see that if we are at $90 per barrel, for example, as an average, it's an example, we'll need to go beyond 1.5 for the second and third quarter. But I think the idea is to monitor it progressively because, again, there is, I don't know if we will be at 80, 90, 100, but we reiterate this commitment, and the board reiterates the commitment in the press release to give you the guidance at least more than 40%. I have added to you that because more than 40 could be 40, 45. I just added to you another guidance to tell you that if we were in a scenario of $90 or $100 per barrel, if there is some cash, priority will be also to deleverage the company, and that if we are able to combine low tens of gearing and higher buybacks, we will do it. That's the idea. So I hope I'm being clear. I will not give you a precise scale. What happened at 75, 80, 85, 90, 95 is mathematical formula. I'm not a perfect engineer, so I prefer you to guess now.
That's perfect. Thank you, Patrick.
The next question is from Martin Ratz, Morgan Stanley.
Yeah, thanks for taking my question. I've got two, if I may. I wanted to ask you about the 2 to 3 month sort of restart time that you mentioned in the release. And I was hoping you could elaborate a bit on what really happens in that period. What are the steps that are on the critical path that make this longer or shorter? Is it getting tankers back into the Persian Gulf? Is it well intervention? Are there critical components in some of the LNG facilities? Can you please make that sort of operational, logistical, sort of what really drives that? And secondly, I wanted to ask you about Mozambique, where we are now with the total budget for the project and the start, the timeline. I remember a $15 billion, but I also heard a $20 billion. Can you just give an update on where we are now?
On the second question, it's easy. $20 billion has been consistent for the last 2 years. 15, it was a long time ago. We have told you that there was some interim cost because of force majeure. We have updated. We have been obliged to renegotiate some of the EPC, contracts because 4 years after, of course, there is inflation. So I've repeated 20 billion in all my speech for the last 2 years. So I repeat 20 billion today, and this is the budget on which we are, and which will put the financing, by the way, on the basis of 20 billion. So the rest is rumors, but this is the point. So this one is easy. The timeline, we have restarted in January, so we have 6,000 or more people on the ground today. So I've been there with the president of Mozambique, and they are already, construction has begun on the train, on the first train and jetty. So the timeline is that the objective and the timing is to produce first LNG by 2029, the first train. So that's where we are sticking to that timeline, and the mobilization is on its way to reach this target today. And on these projects, we have in fact we spent on money not only to safeguard equipment, etc., during 4 years, but also to progress all the engineering and the procurement. So all that has been done. That is very advanced compared to I would say traditional projects. We have a progress at the end of March of the project. If I see the global progress of the projects at the end of March is 42%, in fact. So it's not, we are not starting from crash. We have progressed on these projects, and so it's a matter to be able to construct. By the way, since January, the security situation in Cabo Delgado is quiet, I would say, and is well under control, thanks to the support of both Mozambican forces, but also Rwanda forces, which are committed to remain in the area. Then on the first time. So, I mean, probably I was reading the press release at the same time because, in fact, no, to restart facilities, it does not take 2 to 3 months. The 2 to 3 months is covering, first today, there is no, it's covering the whole cycle that I described in my introduction speech. It's also the fact between the way you will restart oil production, you will bring tankers, you need to, because the tankers which are today in the Gulf are all full. So you have, I think, something like several hundreds of tankers there, so you need to exit, you need to bring some empty tanker back, then you need to shift the new oil to, I would say, some destination in Asia, 25, like I said, it's 25-day shipping, it's longer if you know to go to Europe, so it's a matter of the delay is not only because restarting the wells is not very complex, in the Middle East production is generally quite easy production, so we don't expect difficulties from restarting the wells. It's more restarting the whole system to restabilize it, to come back to the flow where before the war you had every day 50 oil tankers moving in, moving out the Gulf, etc., and charging, loading oil or loading products. So that's this cycle where we estimate 2 to 3 months to have. So it's not exactly what the word is. Restarting is not restarting production facility. Is restarting or coming back to, I would say, a normal mode, which would have been, we should have been more correct in our statement. What I said on the LNG side, I spent some time in Qatar. Is that on Qatari side, it's clearly, of course, we cannot afford to, start on again the liquefaction plants, then start off again if the crisis come back. So I think Qatari very wisely wants to observe, I would say, some certain stability in the situation before to be able to restart. So that might take a little more time, knowing that LNG tankers, the fleet is not as strong, as big as oil tankers. So we need to move the LNG tankers, and then we don't use the Red Sea. We don't use the Red Sea, for example, with LNG tankers. So the voyage to come from the Middle East, from Qatar to Europe is longer. You go around Africa. So this is again an estimation more, but the time that it will take to come back to, say, a normal situation, just to come back.
Thank you.
The next question is from Doug Leggate, Wolfe Research.
Good morning, everyone. I wonder if I could also squeeze into Patrick and Jean-Pierre. Maybe first for Jean-Pierre or for whichever wants to answer this. You're getting an opportunity with these windfall oil prices, obviously, to address your capital structure, perhaps. Obviously, working capital bumped up your net debt, but you also, I guess, added another hybrid bond pending the redemption later this year. I'm just wondering, where would you like to see the capital structure? And in this environment, why hold any hybrid bonds, given those were something of an emergency issue during COVID? That's my first question. My follow-up is, just very quickly, Patrick, I wonder if this environment, as it relates to refining margins specifically, has changed your view on Port Arthur as a core asset.
So perhaps on hybrid. So, we do not increase, the intent was not to increase the hybrid bond portfolio. We are opportunistic at TotalEnergies. The hybrid market was very good in January and February. By the way, it was before the crisis, so before the $100 per barrel price. So we decided to do liability management. So just to anticipate, in fact, the bonds that will mature end of the year by replacing it at good condition. So it was 1.5 billion euros. So that's all. So it's not, our intention is not to increase this portfolio. So just benefiting from good markets, beginning of the year, to in fact, to anticipate the redemption of the bonds.
Okay, that's all the hybrid.
Yeah. What about the capital structure generally, Jean-Pierre? Why not take the opportunity to lower the net debt?
But I said that. I think I told you that. I just told you that the objective, if I want to reach a gearing of low tens, that means lowering the net debt, in fact, fundamentally. So that's the way to reach low tens. So I told you that one of the primary objective, and that will be if we are at $90, $100 per barrel environment, the board, and I convey to you the message of the board, in the arbitration, we have on one side the 40% of payout to shareholder that will stick on. But if some of you ask me to go to 50%, I might answer to you, no, 40%, more than 40 is our commitment. And the extra cash, we prefer to deleverage and to lower the net debt, going down to gearings of 10%, 10 and maybe lower, in fact. So for me, that's part of that's clearly the trend, but I would say the direction we want to give you today. So we share your view. On Port Arthur, yes, you have a buyer for Port Arthur, Doug, or what? You have an idea in the head, or no? I mean, honestly, Port Arthur is a very good asset. You know, it's by the way today making good results. I can tell you, it's a very positive asset in this environment. It has a value for trading teams because it's the only asset. You know, trading is not in our companies. It's in fact optimizing, I would say, our assets, molecules, and there are flows around of assets. They optimize molecules around of assets. So it's the anchor point and we have a strong trading arm in the US, and Port Arthur is, I would say, an anchor point, is a tool for them. So it's on one side for the refiners, a profitable assets, where we have also, I remind you, integrated a lot of petrochemical assets with BTP and Baystar crackers. So it's an integrated platform, and today we benefit from good margins. But you know, for example, today we have engaged and we are on the verge to sign some trading contracts with Venezuela, with PDVSA, and part of the destination of PDVSA heavy crude oil will be Port Arthur, and our traders are developing a trading scheme around flows from Venezuela to the U.S. Gulf Coast. So I think that's the idea on Port Arthur. So yes, it's a good asset, delivering and contributing to the strong downstream results that we have experienced.
Very clear. Thank you, guys.
The next question is from Lucas Herrmann, BNP Paribas Exane.
Oh, thanks very much. Patrick, I wondered if I could ask you about the UAE news overnight and the decision to exit OPEC. What your personal thoughts are, how it leaves you thinking perhaps about the future and the robustness or otherwise of oil prices, just general comments. And secondly, if I can be greedy, any observations on Namibia over the last 3 months, or how your sentiment towards that opportunity may or may not have changed as you've continued to look at the data? Thanks very much.
Yeah. On UAE decision, I will not difficult it's a sovereign decision by a state, which we are heavily involved. We knew for some, not today, but for some years, that the UAE were not specifically happy with the quota which was allocated to them. I think it's quite public by the OPEC, because UAE have made, and we are contributing to it. We are one of the most exposed companies to the UAE, onshore and offshore. They have involved, they had a program to raise their capacity from first to 4 and then to 5 million barrels per day, where we have, by the way, there was a test in January, an official test for the OPEC, by the way, when we reached during a week 5 million barrels per day. So by the way, it's contributed before the war to the good production which was, delivered by TotalEnergies in the first quarter. So this is that decision. On our side, as the CEO of an oil and gas company, we supported the OPEC role in the market. But I've seen that OPEC or OPEC Plus, I've seen that Russia will continue with OPEC, with Saudi Arabia in OPEC Plus. And I think the UAE has also said that they will coordinate with the OPEC on the market. So I think clearly statement, when you read the statement of the UAE, they are investing for growth and they want to benefit for the growth. I would say that's the way I'm reading their statement. Future for oil prices, honestly, Lucas, what happens today, you can see that the oil prices are not only relying on supply and demand, and the pure logic. So I think we have, after 11 years of CEO, I've seen more period of, I would say, external events to the market than really the market itself. So we'll see what will the way that the different countries and the role that each country will want to play in that context. On Namibia, I would say good news for me in Namibia. We have engaged in January with the authorities at the highest level. I went myself, the chairwoman of GAL, together. For sure, I would say this combination of TotalEnergies and GAL in Namibia has been very welcome, locally, very welcome, and it will help everything. First, the sanction of Venus, then on Venus, we have an agenda with the government, which is to make our best on both sides to sanction the project by, I would say, end of July, because we have there again some offers by end of July, tenders. So why is it positive? Because they see our company as being the operator of choice, and we can discuss with them not only on one project, but they see not only our commitment to one, but to at least two projects, if not more, with Mopane behind Venus. So the plan is clear. We want to sanction Venus this year. There is a discussion with the government to amend. This is a very old oil and gas law, in fact, from the beginning of the 2000s, which has never been really used in Namibia. In fact, we are the first, in fact, to be, I would say, to develop a very large project and ultra deep water projects. And that's the point on which I think the authorities understand that these ultra deep water projects require some, I would say, some amendments to the standard terms. So this is on what we work today with them. And again, there is a good dynamic, because we are both sides in a win-win situation, and both we see the perspective of the second project. So on the second project, Mopane, our plan, and again, it will be approved soon. The plan is to, in fact, to have an appraisal program with 3 wells. We want to drill the first one, but it's an appraisal program, let's be clear, not to check if there is a development. There is a development. The question for us, do we have 800 million barrels to develop, or do we have 1.2? So it's a question of reach. And we need to appraise not to miss some resources by rushing to a first development, which will be not optimal for getting, if there is more than 1 billion barrels, we might adapt geographically when you look to the map. It's linked to the last well, which was drilled by GAL, by the way, which opened some doors. But we want also to drill some seismic, OBN seismic, to be sure that there is some resources. The rock on Mopane is better. I would say the permeability is much better. So we are more on a standard development, which will not require some fiscal discussions, I would say. We could do that with the terms because it's more classic. So this one, I would say, the idea and the plan, which is approved with GALP, is to drill 26, 27, finish the appraisal, and then to move to sanction by 28. So one sanction in mid-26, one in 28, and maybe more, because on these licenses there are also still to explore. So there is for me, Namibia will become for us a new anchor country, I would say, by the way, it's a good, I know that I will have some question about the Middle East, but it's a good diversification again, So to have options and to develop the options is a big lesson of what is happening. And on Namibia, we are in a good momentum. I hope I will be able to report to you by end of July that we have really materialized the first project.
Is that still the completion date, Patrick, for the transaction?
The transaction should be completed at the same time or a little before, in fact. A little before.
Thank you.
It's more on the transaction, it's more paperwork, to be honest. Because the partners have listed their preemption rights. So we are more on the paperwork with the Namibia government in order to move forward, and that's it.
Thanks very much.
The next question is from Alistair Syme, Citi.
Hi, afternoon, everyone. Can I get you to talk to the profitability of chemicals in the current environment? I mean, oil and gas looks pretty clear, but I'm not sure how to think exactly about your chemicals business. And then my other question, and this might be a very, very short answer, but what is your trading business doing with tankers in the Straits of Hormuz? I mean, do you have any traffic moving, or do you see any arrangements where traffic can move? Thank you.
I have good news on the second one. We had 10 tankers before the last weekend stuck in the Gulf. Now we have 9, because one of the tankers has moved out of the Gulf during the weekend. You know, when Friday evening, I think both parties announced that the Strait will be reopened. We gave instruction immediately to our traders to try to get out. There were 2 tankers which were in the queue. The first one exited. The second one, unfortunately, was just after the Indian tankers, which was attacked. So, you know, in fact, all that was governed, by the way, by the insurance company, because in fact, we get on the Friday evening the insurance, we were insured to go through the Straits on the Friday evening, and when there was an attack in the Sunday afternoon on the Indian tankers, then the insurance company told us there is no more insurance. So we went back to the Gulf. So this is the situation. Honestly, we are following on this one. Of course, if we can exit, it's the best. But we are following the news, and we depend completely on the discussions between the different parties to the conflict, you know, and that's the situation for us. So this is where we are. We have done a small business within the Gulf. You know, we managed to offload one of the, because we had some a refined products tanker which was stalled, so we managed to offload it in one country and then to load it with some other crude oil. So we try to do what we can inside the Gulf, trading inside the Gulf with these 2 tankers, but it's limited. On chemicals, obviously, in fact, there are 2 different impacts there. First one, naphtha is more expensive because it's rare. So and so it's because it's scarce. So we've seen that the cracker margin went down in March. But the good news is that at the same time, there is a scarcity globally of naphtha on Asia. And as you have a scarcity of Asia, you know, you have some people in Asia with crackers looking for naphtha. Then the price of the polymers have increased, and in April, for the first time for long, I've seen a positive results coming from my polymer business. So I would say, by the way, I've observed in April, but on all our business, including biofuels everywhere, in fact, the beginning of the scarcity implied by the crisis is pushing all our products in the green. I would say we are benefiting from that, and that's the beauty of the integration we have. But I see that on the end product. So there are on the chemicals some downside with the cracker, but the polymers are much better. So and in particular, and in the US as well, by the way, because when you are, and that's the advantage to be on the petrochemicals, not only on naphtha, but part of our chemicals in the US is on gas. And then when you have polymer price going up and unreal or ethane in the US is stable, the margin is much better. So I see some good signals on the chemical business, which are completely the consequence of this crisis.
So net positive earnings in chemicals.
Yeah, exactly.
Thank you.
The next question is from Mark Wilson, Jefferies.
Thank you very much. I think one area we haven't covered yet is refining. You're about the only company that breaks out your refining very clearly in the annual report. In total, it's grown to just under 1.5 million barrels a day, and jet fuel, aviation fuel, is about 10% of that, just over. Could you give us the dynamics between the different main products? Do you have the ability or desire to move the amount, for instance, of aviation fuel that is produced versus diesel and others? And do you see cost headwinds as well as margin as we move through the year and into 2Q, has been mentioned by other companies? Thank you.
Very clearly, I mean, be clear. All our refineries today have been, there was an instruction with the limit of a refinery. A refinery, unfortunately, you distillate, you have a slate of products, but there is ways to optimize. So all of them in Europe, the instruction is max jet first, and then max diesel, and then result in gasoline. So we try to maximize the two cracks, and in particular these days, which are the better, jet fuel even is better than the paper jet fuel, is really high. So maximizing jet and then maximizing diesel, in particular because in France we are a big consumer of diesel, and diesel crack was quite high. And then gasoline, we know that we have enough. European refineries are producing a lot of gasoline, so there is less incentive to do it. So that we do at the max. It's not, we don't go from 10% to 20%. It's a matter of adding 2 to 3%, but each percent, of course, is good for the global refining margin. So that is clear, and we do it. We have done it immediately and systematically in order to be able, because these are the critical, I would say, products, jet fuel and diesel, which we are more relying on imports for the European continent. So of course the margin is better. So it's very logical. We've done that. I'm not sure to have understood the question of the cost headwinds, what it is related to.
Well, there's obviously been a lot of talk about the availability of feedstock and competition for crudes and certain grades of crudes. So is that any impact?
Yeah, okay. In fact, today, I understand. Some feedstock are, I would say, yes, they are scarce, and so they are more expensive. But again, yes, it's an impact. We see some, by the way, there is the refining margin were exceptionally high in March, around $25 per barrel. So I would say I think Jean-Pierre told you that it was very poor in January, February, and the 11.4 margin was a result of a very non-linear, I would say, margin. But in April, there was some volatility in the margins, linked partly to more volatile, linked partially to the feedstock which were coming in the refinery. So that's true. But again, on this one, clearly, I will tell you, there is a very strong connection between refining in the company and trading. And all that is optimized between both of them. And in fact, they are completely, by the way, the suppliers of a refinery are exactly on the same next to the traders. And we interface between both of them in order to optimize the slate which will go to refineries and what we should sell among all our crude oil that our traders have access to on the market. And we make it as an optimization for the company. So it may be not optimal for the trading itself, but if it's optimized, if it's an optimum on the refining and trading as a combination, then we will take the feedstock to the refinery. So this is one of the advantage, I would say, to have this strong integration and to think in particular in this type of period. I know some people were thinking that we might have a lack of crude. No, we will never have a lack of crude. And so we optimize the type of feedstock we need to our refineries according to the access to many flows that our trading can generate.
Thank you very much. I'll hand it over.
The next question is from Kim Fustier, HSBC.
Hi, good afternoon. Thanks for taking my questions. Firstly, on Qatar, how are you managing the force majeure situation in Qatar as it relates to your LNG portfolio and your commitments to customers? Just noting that one of your IOC peers is also a partner in Qatar LNG, had to declare force majeure. And related to that, what is your view on the timeline of the Qatari LNG expansion project? I also wanted to ask about SATORP. What's the repair timeline for the damaged units? And again, linked to that, what is the potential impact on the timeline of the Amiral project? Thank you.
Okay. Qatar, again, I repeat, I don't know why people do not believe us. TotalEnergies has declared force majeure to its customers. That means that, in Qatar, we have some JVs with QatarEnergies, and the marketing of this JV is done by QatarEnergies. So our JV, which are reported in the upstream part, which are, I would say, like the rest, but are not producing today. So there is no production, no revenue, and very logically and very professionally, I would say, QatarEnergies has immediately declared force majeure to its customers. That's one point. From this perspective, TotalEnergies is a customer for QatarEnergies only for our own offtake. The difference between our competitor and ourselves is that because we are very exposed, and we know that to Qatar through the JVs, we have some limited contracts with Qatar for our own offtake, for our own portfolio. And so the amount is around 1.5 million tons per year. So we have this 1.5 million tons per year. We receive the force majeure from Qatar because we are a customer for them. But then we decided that we will not transfer it because, by the way, in the way we work with our LNG portfolio, when we sign a contract with a Korean or a Japanese buyer, we don't tell them it is coming from Qatar because we are a portfolio company. So we took on ourselves, and by the way, we told them we are a portfolio company, we produce in 11 countries, so we secure you the supply. So we decided, yes, we received the force majeure, but we will take it for us, and we could have done it probably, but we decided that it was, in terms of commercial, in terms of what we advocate every day for their customers, the best position, because probably 1.5 million tons is absorbable in a portfolio of 40 million tons, that we will deliver. We will not transfer the force majeure to any of our customers. That's what we've done. I know that our competitor is more exposed because if I read correctly in the press, it's more 6 or 7 million tons than 1 million tons, 1.2 or 1 to 2. So probably with 7 million tons, it was for them more logic. To be honest, my energy traders were ready to exercise the force majeure, but the management said, no, be careful what we do. And so we've done it like that. So no problem. Timeline on the Qatar expansion, I think the Qatari themselves, they have said that today the impact is evaluated to 2 months or something like that I would say on the expansion on NFE first train, because NFE underground, Technip and the teams are continuing to work, in fact, onshore. The offshore works have been stopped. So I think it was planned for Q3 2026. So probably today we are more on Q4 2026. And again, there is a difference in all this wording between when you put the gas in and when you offtake the first LNG. So if you want my bet in my plans, I would say first LNG offloaded from NFE is probably right on the big end 26, beginning 27. That's if I'm taking a bet on that. But that's where we are. And again, this is completely linked to how long this war will last, because as long as we cannot restart works offshore, of course, this might impact the timeline. Setup. So there are 3 units. One, I told you, the first unit will be repaired very quickly, the VGO. So that means that setup is able to produce some VGO from in 10 days. We could produce full capacity VGOs, but then you need to find a market, somebody who buys VGO. And so as we cannot export VGO because the Gulf Strait of Hormuz is closed, we will be limited to something like 330,000 barrels per day during the. And then we need to recover the 2 other units. The 2 other units are the conversion units, which allow us to transform with VGO in, I would say, diesel and noble products. This one, honestly, today, we don't know. We have sent some experts, and we are working together with Aramco. There have been some damage to these units. So it's a matter of at least 6 months, maybe more. We don't know. We are working on it. And when we will have, as we have been very transparent since the beginning of the conflict, when we'll have better news on it, but I would say not Café du Commerce news, we will report to you. At this stage, the teams of Aramco and TotalEnergies are working to evaluate really the damage and more to evaluate the repair. that we need to do. By the way, TotalEnergies, we have an insurance on this type of war events, which we might activate if the damage are higher than $150 million. So this is our own limit, I would say, of threshold for ourselves. Impact of Amiral? No. Amiral, there are 22,000 people working in Amiral today on the ground. That's why we have Oseganis, Aramco. I went in Riyadh. We discussed a lot about Amiral. We have the full support of the authorities for Amiral. So Amiral, again, is progressing. And the progress of Amiral is today at 70%, this project. The startup is planned by end of 27, I would say, beginning 28. But again, it's of course the context might, what I just tell you today, is the conflict was worsening, which I don't hope could change. So this is just an update today with validity, but this is the situation for Amiral.
Thank you very much.
The next question is from Matt Lofting at JP Morgan.
Hi, thanks for taking the questions and congratulations on the performance of the integrated model in what's clearly been exceptional times. I wanted to ask you, you guys engage extensively with host governments globally. It's early days, but are you seeing any change in the tone of conversations as a result of recent events towards greater urgency, let's say, from some countries to develop domestic production and better secure energy supply? And then second, sort of more specific to the financials, price and timing lags are an inherent part of several parts of TotalEnergies business. Wondered if you could just talk a bit about how that impacted Q1, given the sort of surge in commodity prices more kicked in March, and how that then sort of plays out as we look forward to the coming quarters. Thank you.
Okay. On the second question, the obvious case is the LNG, because most of the contracts on LNG are based on have a time lag of 1, even 2 months. So obviously, we don't see, by the way, the average price of the quarter was $8.5 per million BTU, exactly what we planned in February, in the trading statement. On the guidance that we gave in February. So that means that there was no impact on the March oil prices or gas prices. So we expect to see the impact of the March high price clearly will be in the second quarter. That's why we gave you a guidance, by the way, of $10 per million BTU, which again is reflecting price of March, an assumption for over months of $80 per barrel and a TTF around $15 per million BTU. So again, if the crude oil was higher and remain higher, that could impact positively the $10 per million BTU. So this is the obvious case. On the crude oil, we have some few things. We have one country where, by the way, where we have a formula which is with 1 or 2 months delay, is the UAE, which creates, by the way, some difficulties when we are trying to solve them, because when you have a 2 months delay, that means that we could face the day that it will reopen and the price could go down. You could have to pay with 2 months delay. That's not a good situation. We are discussing on that, but honestly, these are the main two. There are also some impacts on polymers and things like that. In plastic world, generally, you have also some delays in all the formulas. So, for example, answering, I should have commented that in March we suffered the naphtha that we bought was on the spot market, but the polymers and all the pricing do not reflect immediately the increase of the naphtha, So that was negative from the naphtha, and this will be recouped in the second quarter. So at the time, beyond 1 to 2 months, we don't have many time lags longer than that. It might be exceptional situation with 6 months or so, but it's very rare, in fact, in the portfolio. Okay. Host government, I think I answered in my first answer to Michele. That was more or less the same question. Yes, I said to Michele, look, it's quite clear that today you begin to see for sure. Again, the governments are looking to what could we develop our domestic production? That's obvious, securing the energy supply. I said electrification. I said more coal for countries who have coal. they will develop their coal. That's sure. India is more coal. Renewables as well. So that's positive for renewables, I think, in many countries, including in Europe. Nuclear will be, again, I would not be surprised to see, there was already a good momentum, but to see a country like India again,